Here's some things you might want to know if you're a high-end financial advisor or tax accountant or estate planning lawyer. I'm going to share something in this video that we were trained when I was a young advisor in that area back in the 1980s. What I'm going to share was taught quite thoroughly in the 1980s and the 1990s, but has begun to fall out of fashion in the last 25 years. And it is about inflation. We were taught, I've told this story before, where I was actually that geeky kid when I was 12 years old. I was tracking stocks and bonds and mutual funds as a kid. It interested me. I had a subscription to Value Line and later on Daily Graphs. I was managing the family's funds at a very young age. I recognized that there was a problem with the money. So this video, I'm going to talk about my insistence that the money is broken and that this is one of the biggest risks facing most of our ideal clients that we're serving. And I want to bring to the present a lot of the lessons that I learned over the years I think will help you a lot as you're serving your clients. So when I was a kid, I noticed that there was a problem with the investments that I didn't quite understand why, because I hadn't been educated enough in this. And it's a problem that I fixed when I got to college, but it boiled down to the fact that I noticed that the investments I was managing as a preteen were going up at a certain pace. But then there was this weird situation where we had something called inflation that was gobbling up the returns. So even when I was very young, I knew that our investments had to outpace this, because if not, then you could grow the money, but if the money's not keeping up with inflation, you've accomplished nothing. Then I go to college and I realize that this is a monetary problem. And I don't know today if it's taught this way, but because I have a background in macroeconomics, I can tell you there's a lot of confusion in the general public. They think that inflation is caused by greedy businesses trying to raise prices in an unfair way, or it's a problem in Congress. They just spend too much money and that leads to inflation. I would say the fiscal responsibility in Congress is a factor, but the actual cause of inflation is printing money. The term inflation has been hijacked somewhere along the line over the last 25 years. Inflation in the mind of many financial advisors and most of the public is price inflation. It's the idea that I go into the grocery store and eggs are higher priced. It's outrageous, and gasoline's going up at an unbelievable rate. And we've all noticed real estate's going up. These are things in your life, but that's price inflation. Again, rising prices are a symptom of the problem, not the cause. Expansion of the money supply is the cause. I'm not going to go into the technical details other than to say, track the measure that's publicly available on the money supply. It's called M2. It tracks the deposits in banks. I don't know if you've thought of it this way before, but this is the macroeconomic view of things. When a bank has deposits on account, those are liabilities to the bank. It's not their money. They're holding it on deposit for you and me. But when the bank loans money for that individual, they have a certain deposit one day, they're approved for a loan. Let's say somebody applies for a $100,000 loan. So their balance in their bank account is X amount one day. They're approved for the loan. The next day, the bank deposits $100,000 in your account. That's $100,000 created out of thin air. That's brand new money. And the point is, this is dilution. Financial advisors have a really good way of understanding dilution, but a lot of them that I talk to, the ones we work with, and these are very high-end financial advisors. Many of the advisors that I work with are the number one advisor in their market. So they're smart. I'm just clarifying that inflation is dilution. Now, what do financial advisors know about this topic, dilution? We're tested on this. If you're registered with a securities license, then you're taught this on the test. If a company has 1,000 shares of stock and the public owns those shares, If they need capital and they want to issue another 1,000 shares so they can get people to buy those shares and pay the money to the company, that's called capital acquisition, then now there's 2,000 shares. What does that do to the original 1,000 shareholders? It dilutes their interest in the company. There used to be 1,000 shares. Now there's 2,000 shares. So those original shareholders were diluted. They now have half as much interest in the company as they did before the new shares were issued. That's dilution. And that makes sense, that as new shares are created, it dilutes the previous shareholders. But for some reason, many financial advisors, I think because it's not taught this way in the universities anymore, but for whatever reason, the idea that we had $100,000 in the deposit account yesterday in an individual's account, they were approved for a loan, and now there's 200,000. That's money that's created out of thin air. That's dilution. So yes, I now have $200,000, but if you look at the history of the M2, the money supply and the growth of the money supply, we are printing new money at an alarming rate. If we just look at the average, and I'm talking about over my lifetime, and I have gone back and studied this my whole lifetime, my father's lifetime, and my grandfather and my great-grandfather's lifetime. So I have tracked this going back to 1855 when my great-grandfather was born. But I can tell you the average going back over my lifetime of new money printed, which is money printed out of thin air, is 7% per year. So why does that matter to a planner? Because that creates a predictable dilution rate that if you do the half-life of the dollar based on 7%, you just have to use the rule of 72. Take 72 divided by 7. That's 10. So that means that over 10 years, the dollar predictably, over my entire lifetime, it's baked into the cake, that the value and the purchasing power of the dollar declines 50% every 10 years. So that means you have a client who thinks, oh, I'm risk averse. I can't be in risky investments. I lose sleep at night. I'll just put my money in a CD in the bank. So client puts $100,000 in a CD in the bank pays them whatever, 4 or 5%. And 10 years, flash forward, they pull 100,000 out of the account, 100,000 in, 100,000 out. They're happy. That's safe. I got my $100,000 back. But what's really happening behind the scenes, which is a silent killer, is that what you could purchase for $100,000 when you open the account was one thing. Flash forward 10 years later, you get your $100,000 out, you can predictably purchase about 50% of the amount of stuff with the 100,000 than you could 10 years before. That's the problem. So when you're printing more money, as the Federal Reserve and the U.S. Treasury counts upon, when the volume of money goes up and the inventory of money goes up and there's no goods produced for that, they just appeared out of thin air, prices go up. Other things go up as well. So every dollar printed dilutes both purchasing power, which is what we think of, consumer price index, yes. But if the consumer's prices are only going up, let's just pick a number, 3%. If they're printing 7% and prices are going up 3%, what on earth is happening to the rest of that inflation? Where's the 4% going? This is going into assets. I'll get into this in other videos if you're interested. If you comment on this and you want me to go into why this happens, I'll be happy to do that. But just take it on faith at this point that let's say 3% of that 7% inflation created by money being printed out of thin air every year at the rate of 7%, it will increase prices. But that other, let's call it 4%, is going into assets like real estate, gold, equity markets. And this is creating a distortion in these markets. So if you've ever wondered why is real estate going up so fast in certain periods of time, same thing for gold. I look at gold right now, it's just exploding. And the equity markets, if you've ever wondered, why would anybody pay 50 times earnings for a company's stock? They have to make earnings for 50 years before you break even on the price earnings ratio. And the reason is because a lot of that inflation is going in to distort asset prices. The point I'm trying to make in this video is a very simple one. The premise of advisors often about inflation is, oh, what are you going to do? You know, that we do the best we can. We put our clients in assets that are designed to grow faster than inflation, but inflation's being advertised at 2 or 3%. I used to calculate consumer price index differently when I became an advisor back in the 80s. I still track it the way they did in the 80s. Currently, price inflation is being tracked without food and housing and energy costs. I don't know what you spend money on every month, but that pretty much is all of my budget, more or less. So back in the 80s, they used to count housing and energy costs, both heating the home and air conditioning, as well as gasoline for the car. And they also had a basket of goods that were everyday goods that people purchased every day, like food and so forth. If you calculated inflation today based on today's prices, the way they did when I first became an advisor, you would get an inflation rate of 10.69%. I would also say I use a 7% inflation rate because that has been the monetary inflation rate on average over my lifetime. But in the last 5 years, it's been alarming. There was a period in fall of 2022. I looked at the M2 and I realized that 40% of all the US dollars in existence had been created within the last 18 months. And that was, of course, after the pandemic. They were flooding the system with liquidity and new dollars. But it doesn't change the challenge that we have for clients. If their purchasing power needs to increase more than 7% per year, the challenge for you is, what can you possibly do to fix that? There is an answer. We're doing a series of videos on digital assets. Bitcoin is growing fast enough, or has at least for the last 15 years, and continues to grow substantially faster than inflation, 4 times inflation. And now I'm not recommending anything. I'm not recommending any investment advice. I'm just making a point. My call to action is you should want to understand inflation better. My hope is that you will come to our site, The Mark of Mastery, or you'll make it your own challenge to go learn about how monetary inflation is the cause of inflation, and that inflation has been defined improperly. It's not prices. Prices are a result of inflation. Inflation is a growth in the money supply, and that is measuring money that is created out of thin air. I want you to understand more about inflation so you can serve your clients at a level that actually helps them get to their goals and not undershoot inflation. And the client's best interest is not served when the actual loss of purchasing power of their money is 7%, not 3%. But the other call to action is to want to know more about Bitcoin. I am saying that for most of my career, we thought the US dollar and inflation was oh, you got to live with it. What are you going to do? We just did our best to try to get the assets to grow faster. But we felt like we were in a jail that we couldn't escape from. It's this cycle of inflation that we have had persistently through the history of the US dollar. But no longer is it a jail cell that you can't escape. The jail cell is actually unlocked. You just have to know more about digital assets and Bitcoin to understand that you can start putting your foot outside the cell and escape inflation. There is a tool right now. It's called Bitcoin. If you'll just understand it better, I'm not saying put everything in any asset class. I'm saying as a percentage allocation of your clients' portfolios, you now have a tool that could potentially solve this problem that I'm describing, which is the half-life of the US dollar is 10 years. So that means it loses 50% of its value in 10 years and another 50% of its value over the next 10 years. Over 20 years, you lose something like 90% of the value of every dollar. I hope this was interesting. I hope your call to action is to know more about inflation at a deeper level in a way that will serve your clients and to learn about Bitcoin. I hope you enjoyed this, and we'll see you in the next video.